Yeah, we've spoken about load shedding and the economy. Nedbank Group delivered a strong financial performance for the year ended 31 December 2021 as headline earnings grew by 115% to 11.7 billion rands, although this was still 7% below the 2019 levels. I first asked him what this financial performance means for the group.
To report more than 100% growth in earnings. Perhaps more important than that, or equally important, is the very strong balance sheet ratios we were able to report. Our capital levels, what's known as CET1 in banking terminology, at 12.8, which is an extremely strong level, very high levels of liquidity, and a significantly increased final dividend. So I think if we look at all of that together, really what's happened here is we've bounced back from the very difficult 2020 when the maximum impact of COVID was evident. We've bounced back much faster than we thought, and I think that's a very pleasing outcome.
Mike, you've also attributed this bounce back to the first half of 2021. South African economy doing better than expected. Then we saw that in the fourth quarter of 2021 there was a 1.2% growth, 4.9% for the entire year. Do you think that we can sustain that level of growth as coming off a low base as a country? And if so, what do we need to do to make sure that we do that?
Unfortunately, I don't believe we'll be able to sustain the 4.9% GDP growth. A lot of that was the bounce back from the extraordinarily low base in 2020 as we learned more to live alongside COVID with less onerous lockdowns. Our current forecasts for GDP growth going into 2022, which are in fact very similar to National Treasury and the SARBs, are just under or around 2%. And unfortunately, that is just simply not a growth rate that South Africans should aspire to. We heard the finance minister say exactly that in his budget speech. And quite simply, if we want the economy to grow faster than around about 2%, we have to do at least two things. Firstly, and we've been very vocal on this for many years, we have to accelerate reform in the economy. And that reform starts with getting more reliable energy supply into the economy. We're back load shedding again today. And it's just a fact. The economy quite simply can't grow much faster than 2% without running out of energy. There are numerous other reforms that we think are absolutely vital. It's good to see some progress on things like spectrum auctions, but there are many other structural reforms that we think are simply taking too long to be enacted. We know there's been a lot of talk around the inefficiencies in our rail and port networks. Off the back of that, there are, again, lots of words around what are going to be done to improve those efficiencies, but we are simply uncompetitive at the moment. So I think that needs a major focus, as well as just generally administered prices. We'll see, all of our clients and customers bearing very strong electricity price increases, very strong increases in rates and taxes for very little service delivery.
In your results, you've also mentioned, Mike, that when it comes to impairments, we saw that impairments actually improved in terms of your clientele actually able to maintain repayments of their loans, their credit, and the like. What is different, and what's the outlook for the bank as far as 2022 is concerned?
Yeah, perhaps the way we would look at impairments most simply is through a credit loss ratio. In other words, for every 100 Rand that we lend out, how much are we writing off as bad debts? And in 2020, remember that was the year of peak COVID impact and lockdowns. In 2020, our credit loss ratio was 161 basis points. We're writing off 1.61 Rand for every 100 Rand that we lend out. Now, our business over time, we think, should run at around about 80 basis points. We've got a target range of between 60 and 100. In the middle of that is 80. Some of what we saw happen in 2020 was the impact of accounting statements that require us to look forward and anticipate future bad debts. So we had a very high bad debt charge in the base year of 2020. That has now somewhat normalized back to 83 basis points, so almost to the middle of that range again.
You reported that your super app, EVO, has hit 1 million customers. That is a huge milestone. As that digital footprint grows, the physical footprint is no longer there. What's actually led to this growth, and what are your targets for 2022?
So, we've been very focused for the last 5 or 6 years on completely refreshing Nedbank's technology stack, as we call it, to make sure that we have a modern, modular, agile, and digital tech stack. We somewhere around about 85% finished on that journey, which means we're kind of nearly done. And what we're starting to see is the benefits of that in something like EVO. And, when you ask me what are our targets for 2022, the target for 2022 was 1 million, and we've already got there in the first quarter. So, I think it's a really fantastic success story built off our digital managed evolution journey.
I want to ask you about the Russia-Ukraine crisis. How is it impacting on your operations or your clientele, and how do you see it playing out as far as South Africa is concerned as the conflict continues?
Yeah, look, I think first and foremost our thoughts go out to the extraordinarily difficult situation so many people find themselves in there, the loss of life and destruction of property, and we really do hope that world leaders can get us to a quick solution to what is an absolutely dreadful situation. In respect of Nedbank, we are a bank focused on the African continent. So not surprisingly, we have no direct exposure at all to Russia or the Ukraine. We have what we would call indirect exposure. That's where we lend to a business that in turn has some operations in Russia or the Ukraine. And that for us is immaterial, really. And in most of these cases, these are global businesses that have operations all over the world, and some happen to be impacted in Russia and Ukraine. So, I think there's very little immediate impact. The real big impact, though, is the longer this dreadful situation continues, the higher we're going to see oil prices and energy prices in particular, and that will drive higher inflation, higher interest rates, and lower growth rates, all of which are not good for the South African consumer.